All right, so we are rolling. A little bit of housekeeping. I submitted midterm grades. If anybody has any questions on any of the grades, get a hold of me and let me know. Most everybody is doing a pretty good job. And if you have any missing assignments, get a hold of me, because it's going to be important that you submit something, or else I'm going to have to put, start taking points off of all of those the graded slots. So I didn't build in missing assignments into the full midterm grade. I kind of put a curve on a lot of the stuff, because there are some people that are not quite getting it, but there are some people that are getting everything right too. So hopefully you guys can collaborate and work with each other to help each other out too. Just not on exams. Don't work together on exams. You can work together on homework, that's fine. And then there'll be a case study where you guys can form groups and work together then too. So yeah, just let me know if you have any questions on any of the grading. The third discussion question is up. I'm going to try and make sure that these discussion questions are available on Tuesdays for the foreseeable future. So they'll be every week, so we can get all 8 of them in. And it's the same format. Just the video, and then questions, and then answer questions. And this whole section, the purpose of this is to introduce you to, where the financial industry as a whole is moving. And there's a lot of different places where it's not just banking and currency. We'll go into a lot of different things like energy and 3D printing and how that affects costs. But tonight we're going to go into characteristics of bonds. And another way to look at a bond is debt. So you're borrowing. If you're issuing a bond, you are borrowing money from anybody who buys that bond on the market. And in return, you can either pay out a coupon rate. So each bond comes with an associated coupon rate, unless it's a zero coupon bond, which we'll get into. And then you get that face value of the bond back after the maturity date. So there's coupon payments, face value, and then if it's a zero coupon bond, then you sell it at a discount to begin with. So then over that maturity time frame, you go from that discount sale price to the face value. So we'll be able to find all that out in this week's material. I'm going to split chapter 6 up into 2 weeks. The first week will cover a lot of the different types of debt that are available. And as you think, like you're working in a financial department, or you're even a manager in your financial department in a business, that you're going to want to be able to find a certain rate on a bond, and then be able to use coupon payments and then eventually the face value to buy similar bonds in the future. So it's this kind of process where you're continually earning that return and looking for a higher return based on past experience. So let's get right into it. All right, describe basic characteristics of debt, some of the different types, discuss bond ratings and the information that they provide to investors, Yeah, ratings are important. And we'll get into that a little bit, but there's bond ratings and then there's credit ratings that have to do with nations themselves. And then there's also, municipal bonds versus corporate bonds. So we'll get into those. Explain how bond prices are determined. And you'll see it's a little bit chapter 5 where we do costs of the money, adding in risk premiums. Let me make sure this is going quicker. Okay, also for learning outcomes, explain how bond yields are determined. So we'll definitely do some calculations at the end of this lecture, and you'll be able to see the difference between the desired rate of return and a coupon rate, because those are two different things, and we're going to build on top of what we've already learned to be able to input it correctly into our build. So I'll show you what I mean by that at the end of this video. Describe the relationship between bond prices and interest rates, and explain why it is so important for investors to understand this relationship. We'll get a lot into that a lot more next week. But for this week, we just want to understand the basics and how to calculate some of these problems. So when this is all just verbiage. When you see these words, they all mean the same thing: principal, face value, maturity value, par value. So those are all what's written on the bond. So most of the time, you're going to be dealing with $1,000 bond questions, but we'll do some, make made up questions so that I can show you how to solve some of these equations that won't necessarily be $1,000 bond. What are the interest payments? So this, with bonds, mostly is going to be coupon payments. And then with other forms of debt, it's straight up interest income. Maturity date. So again, the further away the date to maturity is, the higher the risk. Priority to asset and earnings, meaning we want to look to create financial mechanisms that would increase our bottom line. So if we're issuing a bond, we're borrowing money from the bond buyers. And if we're buying a bond, we're expecting to get a return on that bond because we have to hold it until the maturity date. Control of the firm. So this is equity. And voting rights through debt and equity. Types of debt. So remember the difference between short-term and long-term. Short-term, we're usually dealing with stuff that is gonna come due or mature within a year. So treasury bills are going to be your most common. This is where we get our risk-free rate from. Remember that. Repurchase agreement. So this is you agree to sell an asset and then promise to repurchase those as securities at a higher price later on. So these are kind of we'll get into the verbiage of it, but you're saying that we're going to buy it back from you at a higher price. So we'll promise that you'll make some money on this because we're selling it to you low and we're going to buy it back high. And that's goes along with prediction of where the market's going to go, raw material price, and then still being able to profit. So that's a lot. That's more complicated, but it's widely used today. Federal funds are overnight loans between banks. And remember from economics class, you get into your federal funds rate. What's the discount rate? So from your main central bank to the banks below has the discount rate, which then you build on your own financial products. So a post-dated check is another form of short-term debt. Commercial paper, it's just it's a note, a promissory note. A certificate of deposit is one of the most popular products you'll find at a bank. They give you a certain percentage if you keep a certain amount of money in an account at the bank. So it's not a savings account, but it's a certificate of deposit. So savings and loan is different than CD. Remember that, because savings and loan crisis happened back in the 90s, where we were starting to see unsustainable levels of savings that didn't have the backing from the central bank to get that level of interest paid out. So there was an economic crash back in the early 90s because of that. Euro dollar deposit. So this is it's tricky if you think about it wrong. So just read and reread the definition here. A deposit in a bank outside of the United States that is not converted into the currency of the foreign country. So a bank in France that's not converted into a euro. So then you have to be able to recognize what the value of that account is in all spaces around the world, and that's what the exchange is for. So the currency exchange, where you can look like how many Canadian dollars per one US dollar, how many US dollars per euro, how many US dollars per pound, that kind of an exchange. Money market mutual funds. So these are pooled funds that are invested into a money market. PayPal has one that's available to all people that have a certain amount of money in their PayPal account. There are other easy ways to get into money markets too. But you do need a broker in most cases. And I'll do a little thing later in the semester, show you how to sign up for a brokerage account. I mean, an account to where you can receive shares of stock that is through a brokerage. So now we're moving into long-term debt, term loans. These are very common. And we see a lot of it in homes and in cars, but then also home equity line of credit. So if you've already, technically paid your home off, then they try to get you back into doing improvements on your home. So it's a never-ending process. And I've even talked to some people that have paid off their mortgages, and they're like, I can handle that amount, that payment every month, so I might as well do some improvements. It's like, it doesn't feel right not to have that payment because they last for so long, usually 30 years, but people pay them off sooner. And then bonds, and this is what the main concept that we'll cover today. So it's a long-term contract where a borrower agrees to make payments and interest during the life of the loan, and then repay the principal amount borrowed at the end of the life of the bond. So if you issue a bond, $1,000 bond with a 5% coupon rate, paid semi-annually, we'll see that a lot, either annual or semi-annual. Semi-annual is going to mean twice a year. So you get 2 coupon payments every 6 months. I mean, you get 1 every 6 months, 2 coupon payments a year. So $1,000 at 5% is you're going to be paid $50 twice a year. But then you got to calculate that over time. What's the maturity date? And then you work it into, say, if I want a rate of return at 7%, and I have a $1,000 bond with a 5% coupon rate, what's the value right now? So that's the kind of thing you want to start thinking about. Is there's always a secondary market for bonds that have a particular coupon rate. Then you weigh that against what your desired rate of return is for your company or yourself. So we'll get into how to do that at the end of this lecture. So municipal bonds are issued by state and local governments. And this is all through an investment bank. So we learned about those in chapter 3. And then treasury bonds are issued by U.S. Treasury, and we know that. That's where the risk-free rate comes from, and that's where it can generate a lot of anxiety in the stock market if that rate gets too high or too low for a given set of economic parameters. We have corporate bonds. So, Ford has bonds, and when we get into ratings a little bit later on, all of their bonds were just downgraded to junk. And this was two months ago. The last time that happened was in 2009 after the financial crisis. So it's happened before, and they do have the ability to get back out of that, but it takes into account where your company is heading to. And then mortgage bond, there's a bunch of different names for different types of bonds, but it's backed by fixed assets. Those assets are on the balance sheet. So you'd have to physically write them off to get rid of them. And or amortize, which we'll get into later, which is a reason we want to keep in mind that amortization schedule that we built a couple of lectures back. So debenture is an unsecured bond. Unsecured means that the risk is higher. So it's not backed by any fixed assets. It's not backed by a guarantee, a promissory note, anything like that. So it's just saying this, you'll get this. It just has stated values, but it doesn't have any backing. And then a subordinated debenture comes only in the event of a liquidation. So that's saying after all the primary debt has been paid off, all of these unsecured bonds can be claimed. And if there's no money left over, then you don't get any money. So that's why it's unsecured. So if all the money gets paid to the primary debt holders, then yeah, you don't get any money left over for the debenture unsecured bonds. And a good example of this happened in the Detroit bankruptcy. So I'll try to get into that a little later, but there was a liquidation of debt, and it came down to an agreement between a primary debt holder. They requested that they get the property which Joe Louis Arena and the parking lot for Joe Louis Arena stood on. And then they would write off their $1 billion that was owed to through municipal bond purchases that they made. And that deal went through. So now, I believe they're already tearing it down if it's not torn down, and they're going to build condos and commercial and then shopping right there on the waterfront. So it'll help develop Detroit, but we lose the treasure in the process. But that new arena, the Little Caesars Arena, is pretty cool. I've been to a Pistons game and a Red Wings game already. It's really, it's electric. So, and then I remember the Palace of Auburn Hills. I think it was built in 1991, and just this year they said they're going to tear it down. So, not even 30 years. So that's the useful life of some of these arenas. All right, moving on. Type of corporate bonds: income bond, a bond that pays interest only if a firm earns enough income, which is, you'll find these a lot, and a lot of. So this is different from dividends. This is a bond that holds a guarantee based on income. Puttable bond. You have your calls and your puts. Bond that can be redeemed at a bondholder's option if the firm takes a particular action. Sell. So it gives you the option to not be behind the curve. So you can move at the pace of the company here. Indexed is the rate moves with the inflation rate. So that means that your purchasing power stays the same throughout the life of the bond, which eliminates the inflation premium, which then reduces the default risk premium and the maturity rate. So floating rate bonds, the rates move with market interest rate. So that's a volatile rate. And that can be good or bad depending on where the market is. So this is the floating rate is much more risky. Types of corporate bonds continue. Oh, no, that's an old one. So here we go. Zero coupon bonds that pay no annual interest, sold at a discount below par. So below par means below face value. So you have $1,000 zero coupon bond and you sell it for $925. How much rate of return is that over however long they're borrowing that money? So this is another mechanism to where you borrow all the money now and then you make money over time as a business, and then you pay that $1,000 face value down the road. And then junk bonds are high yield, high risk bonds, generally used to finance mergers, leverage buyouts, and for troubled companies. So that's why I'm worried about Ford right now, because we're not in a recession right now. Last time was in the very slippery slope of the recession, and we're not seeing that. So I'm wondering if Ford's bonds being downgraded to junk has anything to do with, like the electrification of transportation. So just, the more you do these financial kind of thought processes, the more experience you'll get in trying to guess, where something's headed, and then you got to give reason to that guess. So if Ford is headed down because their China market just dropped 30% in the third quarter, yet F-150 dropped too. So it's like here in America. So what are we actually trying to give to the argument that Ford's doing everything right now. But Moody's downgraded their bonds to junk, so that sends a signal to the market. And eventually during the next UAW negotiation, it might have an impact on their workers saying, no, we want more guarantees now because we're worried about the future. And that's exactly what's going on with GM. They are entering their 5th week of strike. There's 49,000 workers out of work, and GM is losing up to $90 million a day, and it could be more. But they can recoup that kind of money once production starts back up. But it's the suppliers downstream of the actual GM workers that have been laid off, and they don't get any furlough day. I mean, they don't get any payments for those laid off days. So there's massive ramifications happening from this strike, and people need to focus on the complete picture, not just the 49,000 workers. It's also 300,000 downstream workers that have been laid off that don't get to recoup any of those costs. All right. Indenture is a formal agreement between the issuer of a bond and the bondholders. So trustee is official and ensures the bondholders' interests are protected. Terms of indenture are carried out. Restricted covenant is a provision in a debt contract that constrains the actions of the borrower. So this is saying, this is what with the contingent. So you'll get the benefits of this bond if, and then you have to complete that if. And then trustee kind of is like you can even correlate it to like the UAW chief, that they're making sure that all the UAW workers are protected. But this is in terms of people who are buying the bonds, so they're borrowing the money to the companies or to the municipality. Call provision, a provision in a bond contract that gives the issuer the right to redeem the bonds under specified terms prior to normal maturity date. So this is options. And people think, oh, I can make a lot of money on options, but experienced traders don't do this very often. Options are they're a bet on a guess. And if you're able to say, okay, it is going my way, so I'll call it in now, then if you're working with a brokerage that charges fees on those options, then you have to calculate the fee into that too. But this is another mechanism here, is getting it out of a bond early to then reinvest in a newly issued bond that might get you a higher bottom line. So you're going to be making more by getting rid of this one and using that money to buy this one. So just keep that in mind, that there are many different, and there'll be some problems next week that have to do with determining if you would want to do that or not. So I'll show you how to calculate those next week. But refunding is the term there. So sinking funds are complicated to understand, but think about it as a fund that helps reduce the cost to a particular entity. So say you're going to borrow money it's like a down payment almost, but you're splitting it up over, you put that down payment in an account, and then year after year, you know, you put money into the bond calculation so that you're not having to pay out. I mean, you're paying out the same amount, but what am I trying to get at here? What's a good way to put this? If you're issuing the bond, you're borrowing money at a cost. Sinking payment would reduce that cost because you can take part of that sinking payment and then part of, your own profits to pay that coupon rate. So that's kind of what it is. And then buy the required amount of bonds in an open market is another way to do that. So you take a piece of the sinking fund, you buy bonds that will then give you more profit, net income over time. So there won't be any questions about sinking fund this week, but next week there will be, and I'll show you some calculations on that next week. But you have to know what the tax rate is because you pay taxes on a lot of this stuff. So I'll show you which accounts to look for and how to use the sinking fund ratio to determine how much you can save. So you can use whichever way is less costly the firm is going to choose each year. So either buy the required amount of bonds in the open market or call in for redemption for a certain percentage of bonds each year, which is you're taking part of that sinking fund and then paying that coupon rate with part of it. All right, convertible. There will be some convertible questions on this week, and it's pretty much saying, if I hold a bond and I want to convert it into shares, then I'll have a conversion ratio, which is how many shares per bond. And if you have $1,000 bond and, the market price per share is $20, then you're going to be able to get 50 shares. So I'll show you how to calculate that and think about it later on. But always look for the conversion ratio, and in the book, it's on page 108. The conversion ratio. So for example, a $1,000 convertible bond with a conversion ratio of 20 can be converted into 20 shares. So if the conversion price is $50, so the conversion price is equal to $50 because you take the face value of the bond, divide it by the number of shares to get the minimum price, and vice versa. You can put $1,000 face value of the bond, divided by the minimum price to get the amount of shares, and then if you want to find out what the face value is, you just times the number of shares by the minimum price. So it's just algebra again, but basic algebra. And I'll show you how to calculate some of that later on. Moving on. So this is ratings. AAA, AA bonds are extremely safe. Investment grade bonds, the lowest rated bonds that many banks and other institutional investors can legally hold. So junk bonds, speculative, extremely high. Junk bonds, some standard high. And Ford got downgraded into this category here. So investment grade medium, you'll see like there's a lot of private firms that deal with equity, and they use equity to buy debt. and then they finance that debt that's rated on Moody's and the S&P. S&P stands for Standard and Poor's, and that's a rating agency. And they also have the S&P 500, which is, the eligibility to get there is you got to be profitable for out of 4 quarters, you have to be profitable. So not like 4 consecutive quarters, but a running 4-quarter tally, you have to be profitable and eligible. So back in the day, the average tenure for a company to be on the Standard & Poor's 500 was 65 plus years. So, we're talking generations, and the family can, give to their family and then to their family, and then this wealth is maintained over time. But nowadays, Standard & Poor's average tenure is 12 years. So that's due to advancement in technology and disruptive innovation, which is pushing these long-standing power structures out of play. And for the first time since 1929, ExxonMobil was bumped out of the top 10. So it's starting to change. And that was just this year, the ExxonMobil thing. All right, bond rating criteria: financial strength of the company, collateral provisions, seniority of the debt, restricted covenants, sinking fund or deferred call provision, litigation possibilities, regulation. So financial strength of the company is obviously something that we're looking at in our studies here, but you always want to look at the cash flow statements and income statements. Collateral provisions, that's saying on all of the debt that you have, what assets are collateral for that. Seniority of the debt, so the longer period you have this debt on the books, the more risky it is. Restrictive covenants, all the ifs, so all the contingencies that go into making the debt viable for the borrowers. Sinking fund or deferred call provisions, so this is how much money do you have like down payment going towards reducing the cost of the debt. Litigation possibilities, this is all about legal and court. So if you're unable to fulfill the what your bond states it will fulfill, then you can get tied up in litigation. And or if your company becomes insolvent, meaning you can't pay your bills, you can get tied up in litigation also. And then you get into class action suits and stuff like that, and liquidations and stuff like that. Regulation is what I do down here in Lansing, pass laws that would cause the value of bonds to change based on where you are around the world. This can be very different. And if there's hyperinflation, then your bond value just goes to nothing. So regulation can be both fiscal and monetary. And that's something that you learn in economics. Fiscal is what the government does, and monetary is what the Fed does. All right, so this is long-term bonds. So you can see here narrow spread, wide spread. So it's the difference between type of bonds. So down here is your government bonds, which are more guaranteed till you get to the risk-free rate, which is below. But this is maybe let's see here. 97 at 2017 20-year bond here. Let's see, in the middle, we have corporate AAA rated. So you can see that it's kind of more risky because it's corporate exposed to all those risk premiums, but not as risky as downgraded corporate BBB. So these are the risks. That's not Better Business Bureau, that's your credit rating. So the lower the credit rating, the higher the yield, but the less the chance that it will actually come. And then you have the default risk, meaning that you won't be able to recover those costs. So the higher this goes, the less likely it is that you're going to recover those costs. And these are all bonds. So this isn't like profit margin. The profit margin is completely different. These are financial vehicles, which if you create a portfolio of, can increase your bottom line over time, and you want to diversify because at any one point in time, exposure to more risk can eliminate one of those for a multitude of reasons that we've just covered. Bond rating is indication of its default risk. Most bonds are purchased by institutional investors who are legally restricted to investment grade securities. So this is your financial managers. Change in ratings affect a firm's ability to borrow long-term capital and the cost of using that capital. So that goes into insolvency, meaning that if you can't pay your bills, you're not going to get the loans, or you're going to get a much higher rate of interest that you would have to pay to get that. All of it's based on time value of money, and we learned about that in chapter 4. Present value, future value. Did some of that in midterm. So anything, value of anything is based on the present value of cash flows. The asset is expected to produce in the future. Here's a timeline, and we've done this before. And now we'll get into valuation, and then we'll go into some Excel problems, and then we'll call it a night. All right, principal amount, face value, maturity value, par value. Same thing as in that first slide up there. The amount of money firm borrows and promises to repay at some future date. So we're talking about $1,000 bond has $1,000 face value, $1,000 principal amount, $1,000 maturity value, $1,000 par value. So that's, try not to let that get you confused in the questions or the exam. Coupon payment is the specified number of dollars of interest paid each period on a bond, generally each 6 months, and that's labeled as semi-annual. So RD is the bond's required rate of return. So that as an investor, I want a required rate of return of 7%, and I have a $1,000 bond that has a 5% coupon value. Then you say, all right, how much is that bond worth right now on the open market? So these are types of things that you'll be thinking of. And remember, coupon value is different than required rate of return. Here's the maturity, dollar interest paid each year. And this in our build is the payment. And the payment is identified by multiplying your face value by your coupon rate, and then if it's semi-annual, you divide that by 2. So it can be difficult to begin with, but the more you do it, the easier it is. Here's the formula you want to use if you're doing it by hand. So keep in mind, all of your, so this is your interest is your payment. Your RD is your required rate of return. So this is your coupon. This is your required rate. So 10%, 15-year, $1,000 bond. So if that's the formula, that's how you would solve for this. And then this is again, I'm going to show you guys how to do it in Excel. So we'll be using this same type of build that we've been using in the previous chapters from 4 till now. Semi-annual compounding, you're dividing by 2 on all of this. So this is all divided by 2, divided by 2, divided by 2. See that? And then you're raising it to 2 times the number of payments because it's semi-annual. So I'll show you how to do that in Excel, which is you multiply your n by 2 and then you divide your interest by 2. So that's, we won't go past semi-annual in most of these questions. So it's always either going to be, if it's annual, then it's what's stated. If it's semi-annual, then you times by 2 in your n and divide by 2 in your rate. All right. So let me open up Excel, do a couple problems, and then we'll let you guys get going. And then, yeah, read the book for some really in-depth, definitions and examples for all of the mechanisms, debt mechanisms we just learned about in this first half of the slides here. All right, so let's go. So I assigned, let's see here. I assigned 1, 2, 6, and 8. So we'll do a couple that makes sense here. So I'll just make one up here for number 1. So we have the face value, our conversion ratio, and our minimum price. Oops. So, all right, I'm just going to make this up because I don't want to do the first one for you. You can do that on your own and send it in. So, Swift Bicycles plan to issue convertible bonds to finance its future growth. Each convertible bond has a face value of, let's call that $1,200, and can be converted into 25 shares of common stock. So conversion ratio is always going to be stock per bond. I mean, shares of stock per bond. So if, let's say we'll do 30 shares per bond. And so the minimum price is going to be equal to 1,200 divided by the number of shares. So it's really that simple. but use this same, process to solve for these inputs in question 1. All right, so number 2, we'll do the same thing here. And we'll say, many years ago, Winding Road Maps issued a convertible bond with a conversion ratio equal to, we'll call it 50 shares per bond. The bond's face value, we'll call it 1,500. For how many shares of stock can a bondholder convert on each bond? So this is just saying how many shares can we get, and we've already done that, so it's already actually stated. If the conversion ratio is equal to 40, that's saying 40 in this my bad. Now I'm answering the question for you. So in our make-believe question up here, if it's saying a conversion ratio equal to 50, spelling that out all the way, it's 50 shares per bond. So the answer for A, for how many shares of stock can a bondholder convert each bond? 50 shares. So a lot of these early questions are trick questions, and they're easy to answer. So A is 50. And then at what price should bondholders convert? So we're looking for minimum price, and that's equal to your face value divided by your conversion ratio answer. So that's minimum price of 30. So use this concept to solve these two. So I just made these ones up to show you how to do these ones. All right, let's move on. Let's do number 4. So Lightning Electric's outstanding bond has a $1,000 maturity value and a 4.5% coupon rate of interest paid semi-annually. All right, so right off the bat, we're going to have to build our equation. All right, so we have information here. Bond, which was issued 5 years ago, matures in 10 years. So you always want to get the maturity date. So it's equal to 10. And then this semi-annually means you want to multiply it by 2. All right, now this is the important piece. You're given a coupon rate. And then at the end of the question, it asks if investors require a rate of return equal to 6%, your rate of return is always going to be your rate box here. So is equal to 0.06 divided by 2. And that's because it's paid semi-annually. So multiply by 2, divide by 2. Present value is what we're searching for, and that says what is the current market value of the Lightning's bond. Looking for this. The payment, this is going to be the hardest part of this new skill that we're learning with bonds here. So your payment is going to be equal to, and I'll put it, I'll put the formula over here quick. PMT is equal to face value times coupon payment. And then if it's semi-annual, divide by 2. All right. So since we do have a semi-annual in number 4, we're going to hit equals. Face value is $1,000 times coupon rate of 4.5% divided by 2. So you have to do this before you solve for present value. Payment type is always going to be 0. Future value is your par maturity face value. So then you solve for present value, rate, and per payment, future value, type. So it should come out negative, and this is saying if I were to buy this right now on the open market, I would have to pay $888.42. So the current market value of the Lightning bond would be listed on the market for $882.42. So you would be out that much. So remember, you got to, the payment part is the hardest part. And we'll keep going. All right, let's do number 5. 11 years ago, Elite Elements issued a 15-year bond with a face value. All right, so we're going to need another build here. All right, let's read this whole thing through. 15-year. So 11 years ago, Elite Elements issued a 15-year bond with a $1,000 face value, 5% coupon rate, paid semi-annually. If the investor required rate of return is 7% to invest in similar bonds, what is the current market value? So it's going to be similar to the one we did above here. But we have a bit of an equation to solve for our N. So we're going to do, so we issued a 15-year bond 11 years ago. And then we're going to times that by 2 because we have semi-annual. All right. Then your R over Y, your interest rate is going to be your rate of return, 7%, and we're going to divide that by 2. Present value is what we're looking for again. Payment is going to be equal to 1,000 times 5% coupon rate divided by 2. So payment is going to be 25, payment type 0, future value 1,000 equals present value, rate, and per payment, future value. So this is saying there's still 4 years left to maturity. It'll be worth $1,000 at maturity. How much is it worth? $931. And that's at a 7% required rate of return. So depending on what your firm is looking for at any individual time, it matters because that's what you're going to use for your I over Y. And then you'll have a willingness to pay this much for that financial vehicle. Because you'll get 8 payments of $25 plus $1,000 after 4 years. So it's an income stream and then a lump sum payment after a certain amount of time. And that can increase your bottom line if you calculate it in right. All right, let's do number 7. Oops. Tracer Manufacturers issued a 10-year bond 6 years ago. The maturity value is $1,000. Coupon rate of 6%, semi-annually. The bond matures in 4 years. If investors require a rate of return equal to 5% to invest in similar bonds, what is the current market? So we have a 10-year bond issued 6 years ago. They do give you the matures in 4 years, so we don't have to calculate that anymore, except for the semi-annual part. So this is equal to 4 times 2, because we have bond matures in 4 years, and we have semi-annual. So I over Y is your rate of return. Investors require a rate of return of 5%, 0.05 divided by 2. What's the current market value? Payment is going to be 1,000 times 0.06 divided by 2. Future value of 1,000 equals PV, right? And per payment, future value, payment type. So now notice now that the value is higher than the par value. Why is that? Because the coupon rate is greater than the required rate of return. So that'll be a shortcut for you in the future. And we'll go into a little bit of why that is next week. But if the coupon rate is greater than your required rate of return, you're going to have a present value that is greater than what you'll end up with. So you'll have to spend $1,035.85 today to get paid $1,000 plus 8 semi-annual payments of 30. So you'll end up with, $1,240 over time, but it's that time that either could be exposed to inflation, default, or maturity risk. All right, let's do number 9, and then we'll call it a night. All right, so we have Desru, wow, company. Yeah, correct me if I'm wrong. I'm not very good with foreign languages. Has 2 bonds outstanding. Both bonds pay $100 annual interest plus $1,000 at maturity. Bond L matures in 15 years, whereas Bond S matures in 1 year. 1 interest payment remains on Bond S. What will the values of the bonds be when the going rate of interest is 5%, 7%? All right, so you can do this like so. All right. Oops, let me insert. All right, so we'll have here, we will have, so who's first here? Bond S. S at 5%. Bond S 7%. Bond L at 5%. 5%. Bond L at 7%. Oops. All right, we can pull this one back. All right, now, so let's go through this again. We have, so bond S has 1 year, so we can put 1 for both of those. Interest rate is 5% and 7%. And those stay the same because we say annual. So it doesn't say biannual, it says annual. So it's just the stated amount. So the going rates are what we're looking for. Payments are going to be, both bonds pay $100 annual interest. And all these all have $1,000 maturity value. Again here, 0.05 and 0.07 equals present value. And per hold on a second here. Let me make sure we're doing that right. And then bond L is 15 years, so just change that to 15. All right. So yes, you can drag across as long as all of your boxes are filled out. So you saw how that, when that didn't have anything there, that was 1,000. But you change the amount of time, and it'll change here. So again, so technically $100 payment on a $1,000 bond is a 10% coupon rate. So 10% is greater than 5% and 7%. So all of these are going to be greater than the face value. All right, so I think that's all I wanted to cover for tonight. So read up to section 6.4 and then do 6.1, 6.2, 6.6, and 6.8. Email me if you have any questions whatsoever on how to do any of this stuff, and if you have any questions on your midterm exam too. And then we'll pick up on yield to maturity next week, chapter 6, and then we'll go into chapter 7, which has to do with stocks after that. All right, so I'm gonna stop recording now, and I will see you guys next week.